The Indian stock market has been on a roller coaster ride lately, leaving many mutual fund investors anxious. With the Nifty 50 and Sensex down by 14 to 15% from their September 2024 peaks, it's natural to wonder, should you stay invested or is it time to cut your losses? Before making any hasty decisions, let's take a step back. History has shown that markets recover over time, and short-term dips often turn into long-term opportunities, and volatility is normal because it's part of the investing journey. So instead of reacting emotionally, let's break down market volatility and how you can navigate wisely. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. The stock market doesn't move in a straight line. It operates in cycles. Right now, we are witnessing a correction phase, and while it may feel unsettling, it's actually a normal part of investing. Key reasons behind the current volatility are mid-cap and small-cap stocks have taken a hit. The BSE small-cap index is down by 18.3% and the BSE mid-cap index is down by 17.9%. So in the Indian VIX, volatility index has surged, signaling nervousness in the market. So fear and uncertainty are rising in the market, and the foreign institutional investors are pulling out money. So this has caused liquidity pressures, contributing to market instability. But here's the silver lining. Corrections create opportunities. Smart investors use these dips to buy quality investments at lower valuations. So, how does the market cycle work? Let's take a look at the bigger picture. Markets don't crash forever. They move in predictable cycles influenced by economic conditions, investor sentiments, and global events. So, understanding these cycles can help you stay calm during market swings. So, number one is the bull market, where stock prices rise, investor confidence grows, and these phases usually last longer than bear markets and reward patient investors. So, in bear markets, stock prices fall by 20% or more, often due to economic slowdowns or policy changes. So, these are temporary and shorter lived. And next we have market correction phase, where a 10 to 20% decline like what we are seeing now could be seen. These are healthy for long-term market growth as they remove excess speculation and create fresh buying opportunities. So the key takeaway from this: corrections are normal. Instead of panicking, focus on the long-term trend. So every major market dip has been followed by a strong financial recovery. So let's take a look at some of the past market corrections. In 2008, we had global financial crisis where the market dropped by minus 50%. So the recovery time it took was 2 to 3 years. In 2013, we had US Fed taper tantrum where the market dropped by negative 10% and the recovery time it took was 6 to 9 months. In 2020, we had the COVID-19 pandemic where the market dropped by negative 35% and the recovery time it took was 1 year. And in 2022, we had the Russia-Ukraine conflict where the market dropped by negative 15% and the recovery time it took was 6 months. So what's the common pattern here? Markets always recover. And what does this mean for you? Selling during a downturn could mean locking in losses unnecessarily. Smart investors don't panic. They stay invested and even use dips to add more. So what does actually drive market fluctuations? You see, stock market doesn't move randomly. They are influenced by a mix of global, domestic, and investor-driven factors. So first, if you take a look at the global economic influences, we have US Federal Reserve policy, where interest rate hikes in the US make Indian markets less attractive for foreign investors. And next, we have geopolitical conflicts, where wars, trade disputes, and sanctions create global uncertainty, leading to market instability. Another factor is commodity prices like crude oil, gold, etc. You see, India imports a lot of crude oil, and when prices rise, inflation soars, affecting corporate profits. And another factor is global recession fears. You see, slowdowns in the US, China, or Europe reduce demand for Indian exports, impacting market sentiment. So if you take a look at some of the domestic policy and economic indicators, first we have corporate earnings growth, where strong earnings push stock prices up while weak results lead to market decline. We also have a GDP growth and inflation to take a look at. So a growing economy supports market, but high inflation reduces the purchasing power. And another factor is government policies, because budget announcements, tax changes and fiscal policies directly impact stock market trends. And another domestic factor is RBI's monetary policy. You see, interest rate decisions affect borrowing costs, which influence both corporate growth and stock prices. And here is where the role of investor behavior plays. So most market swings aren't purely based on fundamentals alone. Investor psychology also plays a huge role. Like you see panic selling. When markets fall, what do many investors do? They sell out of fear, locking in their losses. And we also have something called FOMO investing, where investors rush into rising markets, often at peak prices, only to suffer when corrections happen. And we have something called herd mentality also, because following market trends blindly can lead to losses, especially during market bubble. And another thing is like short term speculation versus long term investing, where you can see market actually rewards patience, but many investors try to time the market, which leads them to losses. Now let us take a look at some of the factors that is involved in institutional investments and market liquidity. So big players influence stock market movements significantly. As you can see, when foreign institutional investors invest in India, markets rise. When they pull out, markets fall. And mutual funds and insurance companies often step in to stabilize markets. So they are called domestic institutional investors. And you can also see the rise of retail investing has also increased market liquidity, but also made markets more reactive to sentiment. So understanding all these factors helps you to stay calm and make informed decisions rather than reacting emotionally to short-term market swings. So how should mutual fund investors actually handle market volatility? So market corrections and volatility aren't a reason to panic. They are an opportunity. Here's how to navigate them wisely. First of all, let us take a look at the power of staying invested. So historical data proves that markets always recover over time. Imagine you sold your investments during a correction period, and you would miss out on the eventual market recovery, because exiting at the wrong time is equal to locking in losses, and staying invested is equal to allowing your investment portfolio to bounce back stronger. So how does SIPs help in volatile markets? First, we have something called rupee cost averaging in SIPs, where we buy more units when prices are low and reducing overall cost per unit. And another thing is compounding, because if you stay invested for the long time, compounding will maximize your returns. So the bottom line is, stopping your SIP or exiting due to fear could be a costly mistake. And one of the smart asset allocation strategy is diversification, because diversification is key to reducing risk, because you need to invest in a lot of different asset classes, like equity, where you can invest for long-term wealth creation, and in debt funds for stability and steady returns. If you can also invest in gold and REITs for hedge against inflation, and also in international funds for global diversification. Rebalancing your portfolio regularly ensures you aren't overexposed to a single asset class. So how should you rebalance your portfolio to manage risk better during market swings? You see, smart investors make strategic adjustments instead of panicking. What they do first is they reduce exposure to high risk sector during uncertain time, and increase allocation to defensive sectors like FMCG, pharma and IT. And they also maintain a mix of large cap, mid cap and small cap funds based on their risk appetite. And they shift profits from equities to debt to lock in gains during the market highs. Now, let us move on to understanding the role of periodic portfolio reviews. Even the best investment strategy need regular reviews, every 6 to 12 months, ask yourself, is my portfolio aligned with my financial goals? Are my mutual funds performing in line with their benchmarks, or do I need to adjust my asset allocation? Because a well structured review helps you to stay ahead of market trends while avoiding unnecessary panic based decision. So, what is the final takeaway from this video? You see, market volatility is a reality, but how you handle it determines your long term success in the market. This is where a certified financial planner CFP can help. Because why do you need to work with a professional like a CFP? First of all, they help you with portfolio analysis, which helps you to assess if your investments are on track. And they also help you with risk management, which ensures you are not taking on unnecessary risk. And they help you in disciplined investing, which helps you to keep your emotions out of your investment decision. And most importantly, a professional will help you in market navigation, because they will guide you through volatility with a data driven strategy that only a professional can give you. And importantly, they help you in wealth creation, which helps you to stay invested for long term success in the market. So instead of making impulsive moves, get expert insights to maximize your financial growth. And click the link in the description to book a free consultation with one of our certified financial planners today for such a professional guidance. So the stock market rewards patience and strategy. Make sure you are on the right path. And if you find this video interesting, give it a like, share and subscribe to our YouTube channel, and I will see you in the next video with much more interesting financial insights. Thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.